In the vocabulary of the modern trader, few concepts are as fundamental, as universally recognized, as support and resistance. They are the invisible lines on a chart, the price levels where the great eternal battles between the forces of supply and demand are fought. They are the floors and the ceilings of the market, the points where trends are born, where they pause to gather strength, and where they ultimately meet their demise. The speculator who can correctly interpret these levels possesses a map to the market's hidden treasures. Yet long before these terms became a common part of the speculative lexicon, one man had already mastered their underlying principles with a depth and a precision that remains unparalleled. That man was Jesse Livermore. He did not call them support and resistance. In his own more dynamic and precise language, he called them pivotal points. This was not a mere difference in terminology, it was a profound difference in philosophy. For Livermore, these were not static, lifeless barriers on a chart. They were living, breathing expressions of the market's collective psychology, the points of maximum tension, and therefore, of maximum opportunity. His strategy for trading these levels was not a simple matter of buying at one line and selling at another. It was a complete, universal, and powerful methodology for extracting profits from the market's great swings, in bull and bear conditions alike. This is a deep dive into those secrets. It is an exploration of how the master speculator read the great psychological drama of the market at these critical price junctures. It is a guide to understanding how he transformed these simple price levels from points of uncertainty into signals of profound clarity. To understand Livermore's approach to pivotal points is to understand the very engine of his success, a strategy as powerful and as relevant today as it was a century ago. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. For those who are committed to this journey of knowledge, who return to these lessons to sharpen their minds after the inevitable setbacks of the market, your support is the fuel that keeps this channel going. To understand Livermore's method, we must first translate his language. What the modern trader calls a resistance level, Livermore typically referred to as a pivotal point at a previous high or the upper boundary of a great trading range. This was a price level where on a previous advance the selling pressure had been strong enough to halt the upward move. It represented a ceiling, a zone of supply where sellers were known to be waiting. The existence of this level was a fact, a piece of historical data that had to be respected. He was not interested in what a stock should do, but in what it had done. Symmetrically, what we now call a support level, he saw as a pivotal point at a previous low, particularly the low point of a natural reaction within a great bull move. This was a price level where, on a previous decline, the buying pressure had been strong enough to absorb all the selling and turn the tide. It represented a floor, a zone of demand where buyers were known to be present. The amateur looks at these levels and sees them as places to make a blind gamble. The professional sees them as places to gather crucial information. Livermore paid immense attention to periods when a stock would trade for a considerable time between two of these points, in what he called a trading range. He provided the example of a stock holding between $22 and $28. In modern terms, $22 was the support and $28 was the resistance. He considered the area between these two lines to be a fool's playground, a zone of uncertainty where the next great move had not yet declared itself. To trade within this range was to be whipsawed by meaningless, unprofitable fluctuations. The real, high-probability opportunity was not inside the range, but at its boundaries. This entire concept was unified under his great central philosophy of the line of least resistance. While a stock was contained within its trading range, the line of least resistance was neutral, undefined. But the moment the stock decisively broke through its resistance level, the path was clear. The line of least resistance was now unmistakably upward. Conversely, a decisive break below the support level was an equally powerful signal that the path of least resistance was now downward. Prices, he knew, will move either up or down according to the resistance they encounter. Livermore's genius was in reading the tape, in seeing the psychological battle at these pivotal points in real time. But one of his great contemporaries, William Gann, believed these turning points were not random, but were part of a hidden, mathematical and cosmic order. While Livermore was the supreme practitioner reacting to the market's message, Gann was the supreme theorist, attempting to forecast these very support and resistance levels far in advance using geometry, astronomy, and ancient mathematics. They were two masters seeking the same truth, the secret of market timing, through profoundly different methods. To explore this fascinating and complex world, to understand the harmony of price and time that Gann believed was the market's secret code, we invite you to subscribe to our new channel, William Gann Trading Insights. The link is in the description below. This brings us to the first great secret of Livermore's strategy, a principle that stands in stark opposition to the methods of the average trader. The amateur looks at a support level and sees a bargain. He buys at support, anticipating a bounce. He looks at a resistance level and sees a top. He sells short, anticipating a rejection. This is a game of prediction, of guesswork. Livermore's method was the polar opposite. He did not anticipate, he waited for confirmation. The first secret is this: never anticipate the hold. Always trade the break. He was not interested in guessing whether a support or resistance level would hold. He knew this was a low probability bet, an attempt to catch a falling knife or to stand in front of a rising locomotive. His entire strategy was built upon waiting for the market to prove that one side of the battle had been decisively won. He did not buy a stock as it approached its resistance level. He bought it only after it had decisively broken through it. He did not short a stock as it fell to support. He shorted it only after it had decisively broken below it. He wrote with the force of an unbreakable commandment, "Do not be too anxious to get into it. Wait and watch the action. Have patience and wait until the stock becomes active, until it makes a new high." The breakout above the resistance level, the pivotal point, was his only legitimate signal to buy. It was the market's own announcement that the great wall of selling pressure had finally crumbled, that the buyers were in complete control, and that the line of least resistance was now clear for a major advance. But it was not enough for the price to simply poke its head above the line. This is where the amateurs are so often trapped by false breakouts or fakeouts. Livermore's second great secret was his mechanical rule for confirming the validity of the break. The stock did not just have to cross the pivotal point. It had to do so with power and conviction. His rule was that a true breakout was only confirmed after the price had moved a margin of at least 3 full points beyond the resistance or support level. This 3-point rule was his ultimate filter, his mechanical method for distinguishing a genuine institutional-led move from a flimsy, speculative flurry. A stock that could only rally a point or two beyond a major resistance level before faltering was a stock that was advertising its own weakness. It was a trap. But a stock that could surge 3 or more points beyond that level on increasing volume and hold those gains was a stock that was providing the highest possible confirmation that a new and powerful trend was underway. It was only then, with this confirmation in hand, that he would commit his capital with force. Having established the foundational secrets of Livermore's approach to translate support and resistance into the dynamic language of pivotal points, and to act only upon a confirmed break, we now arrive at the operational strategy. It is not enough to simply identify the correct moment to act. The professional speculator must have a clear and powerful plan for capitalizing on that moment, a methodology for building and managing a position that is as potent in a great bear market as it is in a great bull market. This was the source of Livermore's legendary versatility. He was neither a permanent bull nor a permanent bear. He was a master of the prevailing trend, and his strategy was a perfect, symmetrical machine for profiting from it, no matter which direction it moved. Let us first examine his strategy for a bull market, for the scenario where a stock has decisively broken through a major resistance level. The amateur, having seen the breakout, is often paralyzed by the thought that he has missed it, that the price is now too high. Livermore knew this to be a fatal error in perception. The breakout was not the end of the move. It was the very beginning. The price was not high. It was now in a position of proven strength. His rule was absolute. He became a buyer only after the stock made a new high. He was not a bargain hunter, he was a strength follower. His method for building a position was a masterclass in calculated aggression. He would not commit his entire line at once. The first break of the pivotal point would justify an initial probe. If that probe showed an immediate profit confirming the validity of the move, he would then begin to pyramid his position. His rule was unwavering. Each succeeding purchase must be at a higher price than the previous one. He would add to his line on a rising scale, his commitment growing in direct proportion to the market's own confirmation of his judgment. This is the art of averaging up, a practice so contrary to the amateur's instincts, yet so fundamental to professional success. The speculator is reinforcing success, not failure. He is letting the market's own momentum finance his increased exposure. With each new purchase, his stop-loss would be trailed up, protecting his initial capital and then progressively his accumulated paper profits. He was building a fortress of profit, brick by brick, on a foundation of proven strength. Once his full line was established, his strategy shifted from accumulation to management. This was the art of sitting tight. He knew the big money was made in the big swing, and he had the courage to hold his position through the minor, nerve-wracking but perfectly normal, natural reactions. His confidence was not based on hope, but on the soundness of his initial premise, which had been confirmed at every step of his pyramiding process. He would not be shaken out by the meaningless noise of the market. He would hold, with intelligent patience, until the market itself signaled that the great move was complete. Now, consider the perfect, beautiful symmetry of his approach. His strategy for a bear market, for a stock that has decisively broken below a major support level, was the exact mirror image. The amateur looks at a stock that has collapsed through a support level and sees a bargain. He tries to catch the falling knife, an act of hope that almost always ends in a bloody financial wound. Livermore saw the opposite. He saw not a bargain, but a confirmation of profound weakness. The break of support was his signal not to buy, but to sell short. He would not short a stock on a rally hoping for it to turn down. He would short it as it was making a new low after it had broken its pivotal point of support. He was aligning himself with the now proven line of least resistance, which was unmistakably downward. Just as in a bull market, he would not commit his full line at once. He would begin with a probe, an initial short position. If the stock continued to decline, showing him an immediate profit, it was his confirmation to proceed. He would then pyramid his short position, but on a declining scale. His rule was the perfect inverse of his bull market strategy. Never make an additional sale unless it is at a lower price than the previous sale. He was averaging his short position down, adding to his line as the stock demonstrated increasing weakness. With each new addition, he would trail his stop-loss downward, protecting his profits from the sharp, violent rallies that so often characterize a bear market. His entire operational framework was built on this beautiful, logical symmetry. In a bull market, he bought strength, and he bought more of it as it became stronger. In a bear market, he sold weakness, and he sold more of it as it became weaker. He was not a man of fixed opinions, but a man of flexible, adaptive strategy. His loyalty was not to the bull or the bear side, but to the right side, the side that was in harmony with the market's primary underlying force. The secrets of support and resistance then, as Livermore mastered them, were not about predicting whether a level would hold. They were about having a complete, disciplined, and symmetrical plan of action for when a level inevitably broke. It was the secret of waiting for confirmation, of pyramiding a winning position, and of having the courage to ride the trend, no matter which direction it was headed. It was a universal strategy, as powerful for the bear as it was for the bull. This is what separates the professional, the 10% who can profit in any market, from the amateur, the 90% who are almost always one-trick bulls, who make money in a rising market only to give it all back, and more, when the great trend finally turns. Livermore's method was a plan for all seasons. It was a testament to his profound understanding that the speculator's job is not to predict the market, but to align himself with its revealed truth, and to have a sound, business-like plan for profiting from that truth. Having now established the great strategic framework of Jesse Livermore's method, to see support and resistance as the dynamic battle lines he called pivotal points, and to possess a symmetrical, powerful plan for profiting from their breach in any market condition, we arrive at the final and most difficult part of the entire speculative art. For a perfect strategy, a flawless map is utterly useless in the hands of a man who does not possess the mental and emotional fortitude to follow it. This final section is not about the market. It is about the man. It is about the profound psychological discipline required to execute these principles in the face of the speculator's greatest and most persistent enemies, his own hope, his own fear, and his own ego. The first great psychological challenge is the act of buying a breakout above a major resistance level. To the amateur, this feels like the single most illogical and dangerous act imaginable. His every instinct, honed by a lifetime of searching for bargains, screams at him that he is buying at the highest, most perilous price. He sees a stock that has already advanced 20, 30, or 50 points, and he is paralyzed by the fear that he is the final fool, the man who is buying at the absolute top. This is the fear that keeps the 90% on the sidelines while the great trends unfold. Livermore knew this fear, but he had conquered it. His courage was not the reckless courage of the gambler, but the cold, calculated courage of the professional. It was a courage born not of a blind hunch, but of a deep and abiding faith in his own proven methodology. He stated, "Timid people don't like to buy a stock at a new high record." But I had the history of such movements to guide me. He knew from his years of study that a decisive breakout into new high ground was not an end, but a beginning. It was not a sign of risk, but a sign of confirmed, undeniable strength. He had the courage to buy high, knowing that the stock was destined to go much, much higher. This requires a complete and total re-engineering of the speculator's mindset. He must learn to equate a new high not with danger, but with opportunity. He must understand that the very act of breaking through a great wall of resistance is a testament to the immense power of the underlying buying force. His job is not to question that force, but to align himself with it. To wait for a pullback, for a cheaper price, is often to miss the move entirely, for the strongest stocks in the strongest trends often have the shallowest and most fleeting of reactions. The great story of Old Turkey, the wise trader Mr. Partridge from Reminiscences, is the ultimate illustration of this professional mindset. While the younger, more fearful traders were constantly snatching small profits, terrified that the bull market would end, the old man simply held his position. His reason was profound in its simplicity. "Well, you know this is a bull market." He was not trading the small, frightening fluctuations. He was trading the great primary trend. His vision was not focused on the minor resistance levels, but on the great underlying line of least resistance. He had the courage to sit tight, a feat that is only possible for the man who has conquered his fear of buying strength. Now consider the opposite and equally difficult psychological challenge, the act of selling short after a decisive break of support. This requires the speculator to fight an even more powerful internal enemy, hope. The amateur, who is almost always a congenital bull, sees a stock that has collapsed through a major support level, and his mind is filled not with caution but with a sudden powerful hope. He sees a bargain. He remembers the glorious high prices of the past and believes they are certain to return. He does not see the break of support as a sign of profound, confirmed weakness. He sees it as a once-in-a-lifetime buying opportunity. Livermore had utterly and completely purged this hopeful instinct from his speculative being. He had no loyalty to the bull side of the market. He wrote with the force of a personal creed, "The bear side doesn't appeal to me any more than the bull side, or vice versa. My one steadfast prejudice is against being wrong. To be right meant to be aligned with the prevailing trend, whatever that trend might be. To see a great support level decisively broken and to remain bullish was not an act of optimism. It was an act of intellectual suicide." This is where the speculator must fight not only his own internal hope, but the great orchestrated chorus of misinformation that so often accompanies a major market turn. At the very moment that insiders are liquidating their holdings, the public will be flooded with bullish explanations for the weakness. They will be told that the decline is merely a bear raid, a temporary manipulative move designed to shake them out of their stock. They will hear from unnamed directors that the company's business has never been better and that a recovery is imminent. Livermore knew this game perfectly. He knew that these stories were a smokescreen, a form of psychological warfare designed to create a market for the insiders to sell into. The professional speculator must learn to be deaf to these siren songs. He must trust one voice and one voice only, the clear, cold, and objective voice of the ticker tape. The break of a great support level is a fact. The bullish explanation is an opinion and very often a self-serving lie. The professional acts on the fact, not the opinion. To master Livermore's strategy for support and resistance, then, is to master oneself. It is to achieve a state of profound, dispassionate detachment. It is to have the patience to wait, for weeks if necessary, for the market to arrive at a great pivotal point. It is to have the courage to act decisively, to buy strength or to sell weakness, the moment that level is decisively broken and confirmed. And it is to have the discipline to trust the resulting trend, to ride it with intelligent patience, and to ignore the constant, distracting noise of your own hopes, your own fears, and the opinions of the crowd. This is the final and greatest secret. The lines on the chart are the easiest part of the game. The true challenge is in the mind. The market is a mirror, reflecting back at the speculator his own internal weaknesses. The man who is ruled by hope will be destroyed by a bear market. The man who is ruled by fear will never profit from a bull market. But the man who has achieved a balance, who can see the market with a clear and unbiased eye, who can act with the cold, mechanical precision of a surgeon, that is the man who will endure. That is the man who will triumph. To truly understand the mind of the man who waged this internal battle more intensely than any other, to witness the epic market campaigns where these very sins were committed and ultimately conquered, the essential chronicle remains Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. This is not merely a book, it is a deep psychological portrait of a master speculator at work, a narrative that gives life and context to every one of these timeless rules. For those committed to this study, a link to the edition featuring a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader, is provided in the description below.